Imagine losing on almost 4 out of every 5 trades you take. 731 losing trades in a single year. That sounds like a disaster. That sounds like someone who should close their brokerage account and never open it again.
The money in your account, it didn't do too well, it's gone.
But what if I told you that those 731 losses, combined with just 209 winners, produced a 969.8% return in 12 months? A return so extreme that it set a new world record in the stock division of the U.S. Investing Championship, beating out 579 competitors from around the globe. That's exactly what Martin Luk did. And no, it wasn't luck. It wasn't leverage gambling. It wasn't meme stock moonshots. It was a system, a mathematically precise system built on one counterintuitive insight that most retail traders will never accept.
What do you mean? I have $100.
Not anymore, you don't. Poof.
The size of your stop loss matters more than the direction of your trade. Today, we're going to break down the exact framework Martin Luk used to produce this return, the math behind his tight stops, the specific chart setups he trades, the position sizing formula, the tools. Martin Luk is living proof that entry, quality, and disciplined risk management are the only things that matter. Let's get into it.
Stan, now more than ever, you need to understand the importance of saving money.
Through Christian's streams and methodology, combined with Mark Minervini's books on risk management and stop setting, Martin began to build a framework, not a strategy based on prediction, a system based on survival and asymmetry. Let's look at the raw numbers, because they're going to challenge everything you think you know about what profitable trading looks like. 209 winners, 731 losers, a win rate of 22%.
So my win rate is further decreased to 22%, but I don't really look at my win rate that closely.
He doesn't even care. And here's why he doesn't have to. Let's compute his expected value per trade. Expected value equals win rate times average win minus loss rate times average loss. That's 0.2, 2 times 15%, minus 0.7, 8 times 2.5%, which gives us 3.3% minus 1.95% equals positive 1.35% per trade. Positive expected value on every single trade, despite losing almost 4 out of 5. Now think about what this means over 940 trades in a year. If every trade has a positive expected value of 1.35%, the compounding doesn't just add up, it explodes. The trader with the 60% win rate, the one who feels like they're doing great, actually has less than half the expected value per trade of someone who loses on 78% of their trades. The math doesn't lie. And this connects directly to what we proved in our last video. Remember, the risk-reward ratio doesn't create edge. Your entry quality creates edge. The ratio is just how the edge shows up in your equity curve. Martin Luk is the real-world case study of that principle. This is the section of the video that I want you to pause and screenshot, because what Martin showed in his Traderlion presentation is, in my opinion, one of the most important mathematical relationships in all of active trading, and it's almost never taught.
So if you look at the blue line, this is for the 25% return trades. So if you are tightening your stop from like 3% to 1.5%, for a 25% return trade, then you can gain a 8.34 risk multiple. So in other words, that it actually can compensate you for for 8 losing trades. So if you are getting stopped out from by like 8 times just by tightening your stop, you can still gain an advantage by just tightening your stop from 3% to 1.5%.
Scenario A, entry at $100, stop at 97, that's a 3% stop. Target 125 for a 25% gain. The R multiple is 25 divided by 3, which equals 83R. Scenario B, same entry at $100. Stop at 98.5, that's a 1.5% stop. Same target of 125. The R multiple is 25 divided by 1.5, which equals 16.7R. Look at that curve. Below a 2% stop, the R multiple doesn't just increase, It accelerates parabolically. This is the mathematical magic trick Martin is exploiting. The exact same trade, same stock, same entry, same eventual price target produces dramatically different results depending on how tight you can get your stop. R multiple equals trade return divided by stop width. This is a simple division, but because the stop width is in the denominator, as it approaches 0, the R multiple approaches infinity. It's a hyperbolic relationship. This is why Martin obsesses over getting his stop to 1.5% or less.
The entry is really right. So it's like maybe a like sniper approach. So if I'm not correct, then I take a loss. That means I'm not entering in the right time.
The tight stop isn't just about limiting losses. It's a position sizing multiplier. When your stop is tighter, you can take a larger position while keeping your dollar risk identical. This is how 0.5% risk per trade translates into the position sizes that produce 969% returns. Let me show you the actual math. Say Martin has a $50,000 account. He risks 0.5% per trade. Maximum loss per trade equals $250. Now watch what happens when we change nothing except the stop. Scenario A, the wide stop. Entry at $25, stop at $24.25. That's a 3% stop. Risk per share, 75 cents. 250 divided by 75 cents gives us 333 shares, an $8,325 position. That's about 17% of the portfolio. Scenario B, Martin's stop. Same entry at 25, stop at 24, 62.5, 1.5% stop. Risk per share, 37.5 cents. 250 divided by 37.5 cents gives us 667 shares, a $16,675 position. That's 33% of the portfolio. Same stock, same entry. Same $250 at risk. But the tighter stop just doubled his shares. And if you're following along on TradingView, try this yourself. Open the long position tool, set your account size, set your risk percentage, and just move the stop. Watch the position size change in real time. The tighter the stop, the bigger the position because you can afford more shares within your risk budget. Now, if that stock runs 25%, which his average winners do, the wide stop, 333 shares times $6.25 profit per share. That's a $2,081 gain, an 8.3 R winner. Martin's tight stop, 667 shares times 625. That's $4,169, a 16.7 R winner. Same $250 at risk, double the profit. The tight stop didn't just improve a ratio on paper, it put him in twice the shares. The R multiple math and the position sizing math are working together, compounding his edge on both sides simultaneously. One winning trade compensating for 16 losing trades. This is the engine of the entire system. Not prediction, not high win rate, asymmetry through precision.
I really enjoy setting a really tight stop and then seeing the stocks to go like really
right away or
takes go right away from my stops.
Now that we understand the math, let's talk about how Martin actually finds the stocks he trades. Martin uses 3 scanners daily. Scanner 1 is the pre-market gap scanner. This identifies stocks gapping up on heavy volume before the open. It flags potential episodic pivot trades, stocks making news-driven moves. Scanner 2 is the potent scanner. This scans the previous day's strongest performers. When multiple stocks from the same industry show up on this scanner, Martin knows a theme is heating up. Scanner 3 is the leader scanner, used on weekends. This scans for the biggest movers of the past 30 days. It captures sector rotation and longer-term thematic momentum.
So from the screeners, if I'm seeing multiple of the stocks that is within the same industry, so for example, maybe yesterday, but yesterday was a down day, but still there are for example, these mining company, like the metals names are really strong. Like there are lots of metal names that are going up. Then I would develop a sense that, okay, so metals could be another, like, but metals is an existing leading theme, so it's not a potential one. But when there's one theme that is not the existing leader, but keep popping up or pops up within the same day, there are lots of the names that pops up within the same day, then it would really catch my attention.
Once a theme is identified, Martin categorizes stocks into a tiered watch list. Lead means the 9 EMA is above the 21 EMA, which is above the 50 EMA. This is the strongest momentum. These are buy candidates. Mediocre means mixed EMA ordering. Watch, but don't act. Lag means the 9 EMA is below the 21 EMA, which is below the 50 EMA. These are the weakest and potential short candidates. This filtering process eliminates the vast majority of stocks from consideration. Martin is only interested in the fastest moving names in the hottest sectors, stocks with an average daily range above 5%, because those are the stocks that can produce the R multiples that make a 22% win rate system profitable. This is the core of what made 2025 different from 2024 for Martin. In 2024, he traded primarily breakouts. In 2025, he shifted heavily toward pullback entries.
Figured out that like the breakouts starting to work less effectively or has a lower win rate. So I got stopped out from the breakouts more often, and stocks tend to shakes me out and they go to the original direction. So I think, okay, maybe I should try to learn pullbacks too, because I see a lot of more and more stocks trying to pull backs into the support areas and find support and then just bounce back right from the support. And so I decided to learn some pullbacks.
Let's break down exactly why with a real trade on NVIDIA. And this is also Martin's first setup in action, the first pullback to a rising 9 or 21 EMA within a constructive base. This is his bread and butter. You're looking at one chart, September through November 2024. As the price action unfolds, I'll show you where each trader enters, and then we'll compare the math. In early September, NVIDIA puts in a base low around $101. Over the next 3 weeks, price rallies inside that base, the EMAs stack bullishly, the 9 crosses above the 21, and by September 26th, it reaches 127.67. That becomes the resistance level, the ceiling of the base. Both traders are watching it. Then the stock pulls back. It drops from that ceiling down toward the rising 21 EMA bottoming at 115.14 on October 2nd. This is exactly the pattern Martin hunts for. A stock that runs up, pulls back into a rising EMA, and snaps back. The faster and sharper that bounce, the stronger the signal. So here's where the pullback trader acts. October 2nd price bounces off the 21 EMA. He enters around 117 on the 5-minute chart. Stop just below the candle low at 115.14. Risk 1.6%. He's in the trade before the breakout even happens. The breakout trader is still sitting on his hands. He needs price to clear 127.67 before he can do anything. 5 trading days pass. October 3rd, the stock closes at 122. October 4th, 124, climbing back toward that ceiling. The pullback trader is already up 6 or 7%. The breakout trader is still watching. October 7th, price finally pushes through that September ceiling. The breakout trader buys at roughly 128. But look where his stop is, all the way down at the base low, $101. That's over 21% risk. Now look at the table. Same stock, same rally to 148.88 by November 7th. But the numbers tell 2 completely different stories. The pullback trader risked 1.6% to capture 27%. That's a 17-to-1 reward to risk ratio. The breakout trader risked 21% to capture 16%, less than 1-to-1. One trader turned tight risk into a massive R multiple. The other needed a wide stop just to stay in the trade. Same stock, same move. The only difference where and when they entered. That's the structural edge of the pullback. A tighter stop because the entry is closer to support. A lower cost because the entry happens before the breakout, not at it.
So I really love the stock that is gapping up and then reverses, or just the stock is opening lower and then just go down and just falling into the support level, such as the EMAs for this case, or sometimes the anchor VWAP.
The second setup Martin relies on is the anchored VWAP break and retest. VWAP stands for volume-weighted average price. Anchor it to a swing low, and it shows you the average price since that date. Weighted by volume, it tells you who's been in control, buyers or sellers, since the anchor. Same stock, NVIDIA. August 5th, 2024. The Japan carry trade unwinds, global markets crash, and NVDA drops to an intraday low around $90. That's your anchor, the capitulation candle. The exact moment panic selling burned itself out and new buyers stepped in. Drop an AVWAP from that low, and for 3 straight weeks, every single pullback bounces right off it. Price climbs from 100 to 129, the AVWAP rising underneath the entire time like a floor. No candle closes below it. Buyers are firmly in control. Then earnings hit on August 28th. The stock gaps down 6%. 2 trading days later, September 3rd, the entire semiconductor sector gets destroyed. NVDA drops another 10% in a single session. Price has now fallen 20% from its high, but the AVWAP from August 5th is still climbing from below. It's heading straight for price. Watch what happens when they finally meet.
The very the important message that I wanted to show is the price is really reacting. I actually if the indicator is, I don't care if the indicator is really fancy or really the formula behind it.
It's gotta work.
It's important to know. Yeah, it's important to know the basic part of it, but the most important part is whether the price is reacting and whether it really works. So I think anchor VWAP works really well.
Now, zoom into September 6th through the 11th. Price has been selling off for nearly 2 weeks, but look at what's quietly building underneath. The anchored VWAP from August 5th has climbed into the 104 area. The 21 EMA is declining into that same zone from above. The 9 EMA is curling right into it. And sitting just below all of them, the $100 round number, a level every single trader on the planet is watching. 4 completely independent levels, all converging in the same $8 window. This is what Martin calls a multiple edge entry, and it's the highest conviction version of this trade. One group of traders is watching the AVWAP. Another is watching the 21 EMA. Another is watching the round number. They're using different tools, but they're all seeing support in the same zone. That concentrates buying pressure into one tight area. The entry comes on the bounce from this cluster. Stop goes just below the lowest level, roughly 2% risk.
When the support level are lining up, those are the really key levels that I wanted to engage in, and you can have an edge. You will have the highest edge if you're buying those areas. So if a trader buys at the anchor VWAP, and also there are another trader buys at the 9 EMA, and another one buys at the previous highs or any support level, then you can there would be the highest probability point that the stock would find support at.
This is Martin's version of a VCP-like setup. Instead of Minervini's multi-contraction volatility pattern playing out over weeks, Martin looks for micro-volatility contraction, an inside day, or 2 tight candles followed by a range expansion via gap up. The stop goes at the inside day low, giving him an extremely tight risk. Now let's compare the two side by side. Minervini's VCP unfolds over weeks to months. 3 to 4 progressively smaller pullbacks, say 25%, then 12, then 6. The entry comes when price breaks above the base on volume, and the stop sits below that final contraction. Typical risk 7 to 8%. Martin's inside day breakout happens in days, 1 or 2 inside days where the range fits entirely inside the prior bar. The entry is a gap up above that range, and the stop goes right at the inside day low. Typical risk 1.5 to 2.5%. Both systems identify the same phenomenon, selling pressure drying up before a move. They just operate on different timescales. But Martin's tighter entry allows for much larger position sizing, which is exactly how he generates those parabolic R multiples we discussed earlier. Now, let's see this on a real chart. Same stock, NVIDIA October 2024. After that September bounce, NVDA rallied back into the low 130s and stalled. October 14th, a full range candle. Pause, mark the high, mark the low. That's your first range, the box. Next 2 days, October 15th and 16th. Both candles fit entirely inside that prior bar. The highs are lower, the lows are higher, the range tightens. That's your second range. Smaller, quieter, compressed. The sellers have completely dried up. Then October 17th. TSMC reports blowout earnings before the open. And NVIDIA. Gaps above everything. Above the inside day high. Above the range ceiling. That gap is the entry. And the stop goes at the inside day low. Under 2% risk. Range. Contraction. Expansion. That's Martin's trade. One more critical piece. Once Martin identifies a daily setup, he drops to the 1 minute or 5 minute chart to time his actual entry. The daily chart tells him where to buy. The intraday chart tells him when. This multi-time frame approach is how he consistently achieves those sub 2% stops.
Normally, I would look for a really fast a flush to the downside into the support level, which is on the hourly 9 and 21 EMA. Is it the 9 or 21? Yeah, a 9 and 21 EMA in the hourly. And then I will look at the 1 minute or the 5 minute or the 15-minute candle for the first breakout of the previous bar high.
Let's walk through a complete trade from identification to position sizing to exit using Martin's exact framework. The stock is IonQ. September 2025, right in the middle of his competition run. Step 1. The weekly chart catches Martin's attention. Look at the week of September 1st. The entire weekly range is under $3. That's the tightest candle in 6 weeks. The highs are compressing, but the lows keep stepping higher. 37, 38, 40. That's a coil. Volatility is contracting while the trend stays intact. Both EMAs are rising and tracking close together. This stock is loaded.
I really want to point out this quantum setup on the weekly chart, because on the daily it looks a little bit messy, like this looks chopping around, undercut the 50, pulling back to the 150, but on the weekly it's actually looking much more cleaner and better, especially on this huge pin bar, also the inside wick. So these two, like the pin bar in the inside wick, just like yelling at me, like, you know, this one is really setting up. It could be another leader. It could be the really good VCP, also the cup with handle. So on the weekly, really stands out from me.
Step 2, the daily chart confirms the setup. Zoom into the base forming between August 29th and September 8th. 7 trading days. The stock chops sideways between 40 and 43, while the 9 and 21 EMA quietly converge underneath it. By September 8th, the gap between those two averages is just 27 cents. On a $40 stock, that's almost nothing. And right at $43, you've got a ceiling. The stock has tested that level 3 times and failed. That's the resistance Martin is watching. Because when a stock finally breaks through a level it's been rejected at, repeatedly, the sellers at that price are gone. There's nobody left to sell. September 9th, it breaks above 43. September 11th, it pulls back, and bounces right off that same 43 level. The old ceiling becomes the new floor. That's the entry day. Step 3, the 5-minute chart. This is where Martin actually pulls the trigger. September 11th opens at 44.34 and immediately sells off. For 15 minutes, the stock drops, candle after candle, all the way down to 43.39. That's the support test. It's tagging that same $43 level we just talked about on the daily. Now watch what happens next. 40 minutes. From 9:50 to 10:30, the stock goes nowhere. It chops between 43.75 and 44.33. Tight, quiet. But underneath that quiet surface, something is happening. The 5-minute 9 and 21 EMA are converging. The gap shrinks from 20 cents to 10 to 5. And at 10:30 a.m. they touch. Zero gap. The same pattern that showed up on the weekly. The same convergence that formed on the daily. Now it's appearing on the 5-minute chart. 3 time frames, 1 signal. The crossover fires at 10:30. And at 10:35, the next candle breaks above the prior bar high of 44.19. That's the entry. 44.20. The stop goes at 43.40, just below that support test from the morning sell-off. 80 cents of risk on a $44 stock. That's less than 2%. And from 10:35 onward, the stock never looks back. It closes the day at 47. Opens the next morning at 47.33. And by the end of September 12th, IonQ hits 56, an 18% gap day, the kind 2 of move, that only happens when selling pressure has completely evaporated and buyers overwhelm the book. That gap day doesn't come out of nowhere. It comes out of everything we just watched, the weekly coil, the daily convergence, the 5-minute crossover. The setup created the conditions. The entry captured them. Now let's do the math. Martin's account is at $150,000. He risks 0.5% per trade, that's $750. That's all he's willing to lose. Entry price, $44.20. Stop, $43.40. The distance between those two levels is 80 cents. $750 divided by 80 cents gives him 937 shares. That's a $41,000 position, about 28% of his portfolio, all from risking 0.5%. Here's the chain. 0.5% risk flows into a 1.8% stop, which creates a 28% position, which captures the entire move if the stock runs. And it runs from $44.20 all the way to $73 by mid-October, a 65% move. That $41,000 position generates $26,986 in profit. From $750 of risk, that's a 36R trade. Think about what that means. Martin could lose 36 trades in a row, 36 consecutive stop-outs, and one single winner wipes all of them out. He's back to break even. Everything after that is profit. You don't need to be right often. You need to be right big. Now, multiply that by the quantum names all moving together, IonQ, RGTI, QBTS, all setting up and breaking out within days of each other. Martin enters 3 or 4 simultaneously. When an entire sector moves, you don't need one big winner. You get 3 or 4 at the same time.
You can see one good trade could give you more than 20 hours or even 30 hours, so you can compensate for your previous losing trades for 30 times. So if you're getting if you're talking really in extreme case, you're getting stopped out for 30 times before you're getting into this trade, you can still be break even.
Martin's exit strategy is more flexible than his entries, and that's deliberate. First, partial sell 10 to 15% of the position. When the stock moves up more than 3 times, its average daily range from entry. Subsequent partials sell another 10 to 15%. Each time the stock makes a notable extension on the hourly chart, final exit, close the remaining position on the first. Daily close below the 9 EMA. Or on a decisive reversal candle if the stock is extended.
My sell rules, I actually don't have a very strict sell rule. I would sell partial into strength in when it's up 3 hour or 5 hour. But sometimes if the market is really strong, and I sometimes would not take partials if I think it is the market is really strong and I have huge cushions on other positions. And yeah, I sometimes would just hold the whole positions, like trail the whole position along the upside. But generally, I would sell into strength when I think it's really extended on the lower time frame.
Let's see how that plays out on IonQ. September 12th, the day after entry, IonQ gaps to $52. That's 3 times the average daily range from his entry. First partial, he sells 15%, 140 shares, locks in about $1,000 of profit, while the position is still running. September 24th, the stock pushes to $67. This is his second partial target take profit. He sells 140 shares, books $3,200 of profit. October 6th is his third target take profit. He exits another 140 shares at $78 for another $4,700 profit. He's now sold 45% of the position across 3 sales and locked in over $8,000. But the remaining 517 shares are still riding. Then October 15th. For the first time since the breakout, IonQ closes below the 9 EMA. 72.41 versus the average at 74.63. That's the signal. He closes the remaining 55% at $73. That final lot, 517 shares, generates almost $15,000 by itself. Total profit across all 4 exits, $23,206 from $750 risked. That's a 31R trade with partial selling along the way. 31R. From 0.5% risk. Notice the asymmetry in his rules. His entries are mechanical and precise 5-minute breakout of prior. Bar high, stop at candle low. Exact. His exits are discretionary and flexible selling into strength, adapting to market conditions, monitoring the overall portfolio. This is deliberate. Tight entries protect capital. Flexible exits maximize the upside of winners. No honest trading video should only show the highlights. And Martin, to his enormous credit, was completely transparent about December. After 11 months of extraordinary performance, Martin suffered a 26% drawdown in December 2025. Nearly all of it was self-inflicted.
December, this is overtrading. And then you can see the table below. So I take around maybe around 70, 80 trades in December. And you can see 46% of the trades I think is really bad trades. But when I mean bad, that then I think I shouldn't have taken it in the beginning. So lots of them are I think a little bit random trades. It becomes like a vicious cycle. So I keep jumping between longs and shorts, but they don't have much follow through. And then I just got punched in both, like slapped in both ways.
Trades taken, 70 to 80. Avoidable trades, 46%. Core problem. Flipping long short in chop. Root cause. Overtrading plus behavioral slippage.
I think December there aren't any like significant losses. Like most of them are really like death by thousand cuts.
Right.
And also the original, like the give back in the profits, like the profits in the existing loans that I've taken in November. So they all add together, like my loans are the profits that my loans are pulling back,
Right.
and then that's the drawdown. That's the first drawdown, and then I started. Okay, should I start doing some shorts? Then this is the second drawdown, and then that's the flip between the longs and the shorts, and it's just further increase the drawdown.
Yeah.
This is a critical lesson. The same tight stop system that produces incredible returns in trending markets creates a specific vulnerability in choppy, range-bound markets. Each stop out is small, but when you take 40, 50, 60 trades in a month and 78% of them lose, those small losses compound into a significant drawdown. If Martin takes 70 trades in December with a 22% win rate, wins about 15 trades times AVG winner, reduced in chop, say 5%, equals about 75% gross gain. Losses. Around 55 trades times AVG loss, 2%, equals about 110% gross loss. Net. Approximately minus 35% gross before partial profit offsets. The lesson isn't that tight stops are bad. The lesson is that a tight stop system requires discipline to stop trading when the market environment turns hostile. Martin himself identified this.
The best way to do would be like trading less. So really wanted to reduce the number of trades this year too. Yeah.
Win rate is irrelevant without context. A 22% win rate with a 6-to-1 reward-to-risk ratio produces more expected value per trade than a 60% win rate with 1-to-1. Tight stops are a position sizing multiplier. Cutting your stop from 3% to 1.5% doesn't just reduce your loss. It doubles your position size at the same dollar risk, which doubles your profit on winners. The relationship is parabolic. Entries must have predictive power. Martin uses multiple time frame analysis, EMAs, anchored VWAP, volume, and sector theme identification to find moments where the probability of a move higher genuinely exceeds random chance. The system works because the entries have edge, not because the exits are clever. The same system that produces 969% can produce a 26% drawdown in a single bad month. Risk management isn't optional. It's the difference between a career and a blow-up. Weekly charts provide the big picture that daily charts hide. Martin repeatedly identified winning setups, including the entire quantum computing sector trade, by checking the weekly chart when the daily looked messy.
In the beginning of your journey, I think it's good to just copy other traders teach you or share, and then. But I think as you progress, as you trade more and have more experience and know more about on your own, then you should maybe adjust it a little bit to make it more suitable for you and develop your own style. And this is really important, I think.
Martin Luk started with $1,300 and a university textbook he describes as actively harmful to his trading. He survived a 50% drawdown that would have ended most traders' careers. He studied for 2.5 years before his equity curve even recovered to break even. And then he produced the greatest single-year return ever recorded in the stock division of a competition that has included names like Paul Tudor Jones, Mark Minervini, David Ryan, and Ed Thorpe. He did it with a 22% win rate, a 1.5% stop loss, and a system built entirely on mathematical asymmetry. No evidence, no trade. If you found this valuable, subscribe for more breakdowns of the real math behind trading. And if you haven't seen my other videos, the qullamaggie deep dive and the upcoming mathematical proof on risk-reward ratios, go watch those next. They're the foundation everything in this video builds on. See you in the next one.